Hey everyone, it's Daniel here from Infovest. Hope you're all doing well. Just want to talk about Fed Waller. A couple of comments that he made last week. Basically, Fed Waller is a hawk, so it is as expected that he would say hawkish things. He would say things that, you may not like to hear when it comes to interest rates and the financial markets and so on. But, since, we're in a blackout period, the Fed meeting is coming up, and these guys are restricted to talk. The last Fed member to really talk was Fed Waller and wanted to go over some of the comments that he made. So, starting off, he said the Fed will have to keep rates high and not cut rates by the end of 2023. Markets are expecting some sort of cut in 2023 by the end of 2023. And it's pretty interesting that the markets on that day basically rallied, even though Harker said something like this. Of course, keeping in mind that he is a hawk, so whatever, right? But again, the equity markets here are not believing that, hey, you're not going to be keeping rates high all up until 2023. There is going to be some sort of cut by the end of 2023. That's what the markets are predicting. So the market perception of the terminal rate is not far from where we are. Okay, it's not bad. Market expectation for rate cuts later this year is driven by optimism inflation will melt away. The Fed does not expect inflation to melt away. So remember, before they start cutting, there's got to be a pause. And that pause tends to be around 6 months or so. So if we're going to pause, or in May, so May, June, July, August, September, October, November, December, maybe they could still pause up until December and then cut maybe January 2024. So that's a possibility. So the markets could get it right that, yeah, end of the year, December, there's going to be a cut. But again, we will need to see that pause first, right? In order to get to that rate cut. And right now we haven't paused yet. Rates are still moving up higher. So he then goes on and says, need to keep rates higher for longer because of risk management. Okay, hard to talk market out of their forecast. If loosening financial conditions means inflation takes off again, we will require us to do a lot more. Very important point here. If loosening financial conditions means inflation takes off again, will require us to do a lot more. He's talking about the stock market. If the stock market continues to go up and everyone buys it thinking that, hey, the recession's over, don't worry, all-time highs again, and it trickles into inflation, or inflation is not coming down, they don't like to see the financial markets moving up higher, as it causes easing conditions. Whether you agree with them or you don't agree with them, I'm not here to debate about that. But the way they look at things from their lens and their point of view is that if they see a higher stock market, that's easing condition, which means they got to do more, which means more rate hikes, which means the pause is delayed, which means the crash could even be really worse off, or the recession, or definitely a very ugly hard landing, right? But let's see. A lot can change over the next coming months. 2022 was humbling experience. Logic led Fed to think inflation would be transitory last year, but that was a mistake. So, very interesting here, because they thought inflation was transitory. It was a mistake. Now we're seeing the Fed basically over tighten, which again, a lot of people are saying is another mistake. So they're doing mistake over mistake over mistake. Something's going to break. How much further rates need to go depends on the data. Okay, it depends on inflation, depends on how much inflation is coming down lower. And remember, inflation is coming down lower because the economy is deteriorating, because you got less demand, because less buying, etc., right? So to get it to their 2%, it needs to continue. Economy needs to do worse off. Hard landing, maybe. If inflation pops back up, rate hikes won't stop. Okay, so they're saying more inflation, more rate hikes, 6%, 7%, and so on. Okay, we understand that. Tech workers who lose their jobs are quickly picking up other jobs. So very interesting. I said this in a previous video as well, that look at the initial jobless claims number hasn't picked up because they have lost their jobs. They're probably getting some sort of severance. They're looking for a job, or they may have already received or got another job and they haven't filed for those jobless claims yet because they may not need it right now. But a couple months down the road, if they got no jobs, then sure, they will need it and that number will spike up. So we'll see that number, because there's a little bit of a delay, we'll see that number maybe truly see the true results of all these layoffs maybe later on in the months to come. But let's see. Wage growth above productivity is a concern. Otherwise, firms will lay them off as too expensive. So definitely wage growth is still something to keep an eye out on. Customers are much more price conscious, taking pricing power from firms. You can't pick a lot of weight on just a few months of inflation data. So he says, hey, stop saying 1, 2, 3 months of inflation data is more than enough. They want to see multiple more data. Again, they want to get to that 2% target, and then we're talking. We have to wait to see through the summer how inflation is going. So again, in previous video, like I said, right, the effects of 4% interest rates, we'll probably see it in the summertime, and we'll see what inflation looks like at that time. It's just wait and see right now. We are talking about maybe 75 basis points of hikes. Sorry, I think I skipped one line. If markets are right and inflation is coming down, that's great news. Would have no problem changing policy. We're talking about making 75 more basis point of hikes. So again, three more hikes as the Fed has penciled in. But markets are saying no, you're going to do 2, so only 50 basis points. Let's see who's right. I need 6 months, not just 3, to pause. Like I said in the previous video too, 6 months to pause, not 3 months. 6 months. So if we're pausing, let's say starting from May, June, July, August, September, October, maybe November, that's when maybe you could see a rate cut if inflation reaches to their goal, we have a hard landing, recession, etc. Really, it starts to get bad out there, right? So remember, the minimum is 6 months of the pause. So if there's a recession, it would be mild and short-lived. Okay, kind of disagree with that, but hey, the Fed is never going to come out and say that, hey, recession's coming, careful guys, run out and start running around like a chimpanzee and get your stuffs together and be ready for the worst of the worst. They would never say something like that. Never. They would never in history price in or tell you that a hard landing is coming. Even if they do believe, even though they do see that a hard landing is coming, they're going to say mild and soft as always. So be careful. Most likely will slow balance sheet runoff when reserves 10% or 11% of GDP. Both demand and supply have been contributing to inflation. Policy lags are no longer than 12 to 18 months as they once were, but are more 9 to 12. So basically that means policy lags, I did a video on this where their researchers basically said that these policy lags that everyone is talking about, that it takes time for inflation to show in the markets, and the Fed is following very old, late, delayed data. There basically came out a report that no, actually, the lags are much shorter than usual. So again, you could have a full debate on this, whether they're right, whether they're wrong. Usually they're kind of wrong, but hey, you didn't hear it from me. Expects to see policy impact coming through in the next quarter or so. So again, so pretty when you look at the the comments and the stock market basically reacting positively to the remarks, I'm just reading through this article a little bit more. Haven't really heard a Fed member admit that they would love to be wrong. Most would raise rates to 5.25, keep rates there extended period of time. Waller did say that see not rates down. If wrong, would be happy for lower rates. So basically, in other words, just to summarize the last point, is that they don't want to make the mistake. They don't want to make the error, right? They don't want to go out and basically say that, hey, we raised rates. We haven't raised rates aggressively to bring inflation down. Waller did say that we want to be wrong when we're wrong, because if we're wrong, we have the policies, we have the tools to basically cut and prop up the markets back again. So that's why they're over tightening because they don't want to be wrong if they start pausing or cutting very early. If they start pausing and cutting very early, then they will look really, really bad. So yeah, they've got to continue with the over tightening if they're over tightening, and then they will wait and see, pause, see how the economy is, markets are, job market, etc., and then come to the rescue when it's needed. So pretty interesting there. Hawkish comments, in my opinion, or in line, whatever you want to call it. I look at it more that, they're still hard-headed on these rates. The fact that they want to pause, and the pause is not going to be short, it's longer. I think the equity markets are mispricing this wrongly, and they're thinking some sort of hero is going to come soon in the markets, and I don't think so. You've seen previously in 2008, 2001, even when they've done rate cuts, the stock market still sold off. So let's see. Again, things, every recession can be a little bit different, but definitely these are signs and signals for me that tells me that more tightening is probably going to come, and it's not looking good. So let me know what you guys think. Leave a comment below. Hit the like button, the subscribe button to follow me and hear more content like this, and the bell icon to also be notified on the next video. And I'll see you guys around. Cheers. Bye.